Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the moving average convergence divergence, also known as the MACD or the MACD. This is a technical tool used by a lot of traders, and it's a very powerful tool and has a lot of information in it. So this is going to be a two-part video series, where the first video in this series will discuss all the elements of the MACD and what it's telling you, and then the second part will show you how to trade with it. Okay, the second video in the series will show you how to trade with it. Okay, so what is this and how does it work? Well, it's what its name sounds like, the moving average convergence divergence. Moving averages used in the MACD are two exponential moving averages, the 12-day and the 26-day, or 12 period and 26 period, and those numbers are right there, 12 and 26. That's the default setting that most people will use, very common to be seen on people's charts. You can alter them for shorter time frames, or make them larger numbers for longer time frames, but most people would simply just use them as they are. And I recommend you do that until you actually understand everything there is to know about the MACD. So what is the MACD's line itself? There's a lot of information being portrayed here, so let's go over it piece by piece in little baby steps. The MACD line is this black line that you see right here. It's a wavy line, moves up and down, and that line is actually the difference between the 12-day exponential moving average and the 26-day exponential moving average. That's all that is telling you. And the way it's figured is basic math. You just subtract one from the other and you conclude the actual point here. Whenever those two lines are at touching each other, just before they cross over, when they're touching, you'll see that the MACD will be on this black line you see right here. This is known as the zero line, and that is telling you that there is zero price difference between those two because the moving averages are touching, and therefore the MACD line will be on the zero line. Okay, this over here you see of positive numbers, and then reported over here in negative numbers. When the 12-day is above the 26-day exponential moving average, it is considered a bullish, and therefore when you're in that situation, the MACD will be above the zero line, reporting in positive numbers. When the situation is reversed and the 12-day falls below the 26-day exponential moving average, it is considered bearish, and that's why you're going to be seeing it reported in negative numbers. Now that we understand the MACD line itself, we know that what it's reporting, and whenever it's reporting a high number, we know that there's a larger divergence between the two exponential moving averages on price chart. That's what the convergence divergence is all about. Here we're having a divergence there going away from one another, all right? And here we have convergence where they're coming closer to one another, okay? We also now know that anytime the MACD line crosses the zero line, this is the zero line again, this is the MACD line, this black line, when it crosses there, it crosses the exact same point that the 12-day exponential moving average crosses the 26-day, and depending which way it crosses it, we know whether it was a bearish cross or a bullish cross. The next item we have making up the MACD indicator would be the 9-period exponential moving average. This number 9 right here is what that is reflecting, and that is this red line that you see right here. It is simply an exponential moving average placed over the MACD so that you get what's known as a signal line. That's what that is. Okay, this red line right here is a signal line, also known as a trigger line, and we'll show you how that benefits traders by explaining it in another way. Let's assume for a moment that you wanted to trade based on the crossover of these two EMAs. When you have a situation where the 12-day or the 12 period crosses below the 26 period, it's considered bearish. But in this situation, this has already happened. This sell-off right here has already happened before you get this indication. That is because moving averages of any kind are lagging indicators. So you are at a disadvantage from a timing perspective to wait for the cross there. And so if you were to say wait for this and start shorting now, you've already missed half of this move. So the MACD was developed, and you can see that when the let me clean that up again. When the MACD line crosses its 9-period exponential moving average, it's an early warning that you're likely to about to see a cross like that. All right, when it crosses to the downside, it's warning that you're going to be seeing a cross to the downside of the 12-period exponential moving average crossing below the 26-period exponential moving average. So that kind of gives you an early warning that it's going to come, and that can help you because you can then start doing your selling here as opposed to way down here, right? The last element on the MACD is the histogram. These light blue colored bars that you see here is the histogram, and it is reflecting the difference between the MACD line and its signal line. So it's analyzing that, okay? And it's giving you an early warning of before they're going to see an MACD cross of the signal line, the 9-period signal line. So that's just another step of earlier warning that this thing is coming, okay? But you need to keep that in mind, that it's an order of operation. First thing that you will see trend down will be, let me clean that up, the first thing you'll see trend down will be the histogram. Then you will see the cross of the MACD line crossing the signal line, and then you will see the actual cross on the exponential moving averages, which is the exact same time that you will see the MACD line crossing the zero line. So there's 3 different things being reflected right there, but there's an order of operation, and one's going to happen before the next, and then that one will happen before the next. That's important to note when you get to the actual trading aspect of it, because a lot of guys will look at the divergence on a histogram and then look, and say, okay, well, I'm going to start shorting now or start buying now, depending on the type of divergence, and they'll find that they're very, very early or their timing's off, and that's because you're using the order of operation without thinking about where you are in that overall timing situation. Typically, you'll see the histogram begin to warn of a breakdown before you actually get it in price activity. So you're being really early if you're just looking at the histogram. We'll get into that in the next video, but now you understand the full information that's being portrayed to you on the situation that you have of the MACD. Now remember, that zero line, the positive and negative, is going to be true with anything. It's anytime you're seeing information portrayed to you in a positive or a negative light, it's telling you something. So when you see the histogram itself showing a positive situation, then you know that the MACD line is still above the signal line, the red line. And when you see it reported in a negative, below the zero line, the histogram bars are below the zero line, then you know that during that time period you have a situation where the MACD line is actually below its signal line. So a lot of information is being portrayed here. Okay, a quick recap. If you now understand what the MACD line is reflecting, if you understand what the zero line is reflecting, if you understand what this red or signal line is for and what it's reflecting, and you understand what the histogram is and what it's reflecting, and you understand the actual negative numbers and the positive numbers and why that's important, and you can further understand the concept that you have a order of operations where the histogram will signal one thing, then the cross of the MACD and its signal line will signal another thing, and then the actual cross of the MACD and the zero line will signal yet another thing. If you understand all those concepts, then you can now start to contemplate trading on the MACD signals that you may be getting. So go ahead and watch the second video series now, okay? Thank you for your time. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.